Hello, and welcome back to our weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the market up 0.41%, an all-time high for the S&P 500, brings us up year to date 13.07%. Really not a ton of market catalysts this week. Now, one thing that did come in was the CPI data for May, and that did come in and has some significance that we'll get into. But besides that, it's been relatively quiet.
It's also a very well-known proverb that there's not a lot that happens between Memorial Day and Labor Day, and that you can go home and ignore the market and come back, and there may be a lot of ups and downs, but nothing really much happens between the two. Old wives' tale.
As we get into the market, some interesting catalysts that we see. Nothing huge standing out. And then as we get to Thursday, we see this huge jump in the market, followed by a sell-off and then just a steady rise. Well, the market was falling into the CPI data. All of a sudden, the CPI data comes out. The headline number of 5% year over year, really scary. But then once you dive into it a little bit deeper, it might not look as scary. So the market actually held up pretty well seeing that data. There was a dip, but overall, by the end of the day, it was up significantly. And then Friday, just not really a lot of news moving the market. A little bit more of a rotation back into growth from value. But again, to be expected when we had inflation not come out as scary, growth comes back into play a little bit more. So that's really what we saw on this past week. If we jump into the actual underlying data, the first number that we want to highlight is this increase 5% before the seasonal adjustment. So that's over the last 12 months. Now, what we need to remember is that May of 2020 was the worst month that we saw for prices. It fell the most, and then it started to recover. So we were expecting on this 12-month look to be the worst number. So as we go into June's data, when we get it next month, it should be lower than that, or hopefully around 3 or even less than that. That would, be back in the norm. If we look month over month, we're right around 0.6%. Now, obviously, that's still extremely high if we were to annualize that rate. But while supply chains are still constrained, while we're opening up, it's not super scary. And we were expecting around 0.7%, 0.8%. So having 0.6 didn't significantly underperform, didn't significantly overperform. So overall, it's a good reading.
And let's remember, weather is warming up. Many people are starting to go out. We have very large numbers, percentage-wise, of population that's been vaccinated for COVID-19. And so people are feeling more comfortable going out to restaurants, going on vacations. And what we're seeing is a huge blip from all of this demand. Airline travel prices have gone up 100%, while they were practically giving away tickets and seats a little bit earlier.
Yeah, Rich, if we even just look down, we can start to see what the seasonally adjusted prices were from the month before, and we can start to look at some of the massive outliers. And one of the things that really stands out is the used cars and trucks. I mean, the 7.3%, that's pulling everything up. If we look the unadjusted 12 months, it's up almost 30%. Energy up, 54, 56%. These are significant jumps. There are certain areas that are pulling up the rest of the CPI significantly. And honestly, that's better for a scary number. So obviously we don't want to see CPI at 5%. That's still a scary number, but would you rather see CPI at 5% with airlines rising 30%, or would you rather see CPI at 5% with everything rising 5%? Well, I'd much rather choose this one area that is lifting up everything versus across the board, things really going up significantly. So as we look into the deeper data, There are a few pieces that stood out more than I was expecting. Overall, we were, 0.6. Anything that's significantly above that is things that really added to it. So as we look at meats, poultry, fish, and eggs at 1.3, that's a pretty significant jump. Fuel, 2.1. That's a pretty significant jump. We already talked about it, but used cars and trucks up 7.3%. Airline fares, this is what Rich was talking about, 7%. This is just in 1 month. So that's a pretty massive jump. But one thing that really feels stable and safe is that once we start getting down to the services, now there's not a bunch of services that are measured in CPI, but there are definitely some, and they're normally at the bottom. As we start seeing the services, they're all under. So it's actually pulling this down. Now, moving, that pulled it up, and domestic services, those were high. But really, besides that, a lot of the services are really low. And I think that gives a huge sigh of relief to people who are really afraid that inflation is here to stay. We're going to start seeing these 5% year over year. We're going to get back to what happened in the 80s with these massive inflation numbers. I'm not worried about that until if we start seeing all the service related industries rising at that pace, then I think it's time to start being okay. The Fed's probably going to have to raise interest rates. The market's going to sell off because of that. But until that moment, I'm not really worried. Moving on to the other part is the market, again, keeps rising, but not these massive catalysts going on. And I think it sets up a pretty good backdrop for equities to continue to rise for the time being, unless we see inflation start to come in higher or something else. I think we could see just a steady rise for the next few months without any massive catalyst. Like you said, Rich, walk away for the summer, come back, and nothing really happened, but we're up a little bit.
That wouldn't be a bad thing. We've seen that before in the 90s, where we just had markets going up on a relative constant basis. That would be a good thing.
Yeah, I also think, as you alluded to, with earnings season, now we're not quite there yet, but as we come, to quarter end of June, earnings starting, mid-July, it might be kind of nice to have the stock market just slowly creep up to allow earnings to maybe catch up, so we're not at this elevated valuation where we are across the market. We are still over one standard deviation above the historical norm for the PE ratio, which is the price of the equities that you have per earnings of the company. So honestly, if we saw equities just slowly rise while earnings might have some time to catch up, I think that's a win-win situation. We're already up, 13%, in the broad market. Now, caveat there, we're up 13%. Growth has almost sold off over the year. So there have been individual sectors that have sold off significantly. But across the S&P 500, we're up 13% this year. If earnings rise significantly, hopefully equities stay within, this same range and we start to trend to norms.
That would be wonderful.
Yeah, it would be wonderful. We'll see if it happens. Well, anyways, we appreciate you all tuning in this week. Please give a like on this video, share it, subscribe to our YouTube channel. As always, we're here to support you. Your money's here to support you. We'll see you again next week.